Sean, all the way from London, co-founder and chief investment officer at Ranmore Fund Management. Sean, thank you so much for joining us this morning. Really great to have you, and you can start when you're ready.
Eugene, thanks very much for the opportunity, and good morning, everybody. So what I thought I'd do today is something slightly different. You often hear commentators, and we've already heard it this morning, what is the right environment for value investing? We're a value asset manager here. We run a value fund. And so I thought we all understand property. Many of us own property, some lucky enough to have a few properties. So let's use an example in the UK property space and just explain value investing for that perspective. So what we've got here is a property in Belgravia, one of the top suburbs within London, SW1X, and you can see that this property over here is on sale for 43.7 million. And if you're quick with maths, you'll figure out that that's R1 billion. And you look at this and you go, well, it's a very plush property. We've got lots of chimneys for R1 billion. But unfortunately, it's only one row of chimneys. It's number 12. Okay, so what are you getting for R1 billion? What are you getting? 706 square meters. And it seems like quite a high price to pay. But you're not just getting 706 square meters. You're getting a nice fireplace. And that can come in handy in UK winters. And you're getting lots of wine bottles and a lovely dining room with marble floors. And you get a copper bath. And you get a nice swimming pool, lots of marble everywhere, okay? And you're getting 6 bedrooms, 6 or 7 bathrooms come in handy if you've got 6 teenagers who spend as much time in the bathroom as ours do, and it's a new development, okay? So you're paying top dollar, it's a quality house, quality fittings and furnishings in a quality suburb, but it's certainly coming at a big price. Now, just down the road in SW1V, what have we got over here? Well, you've also got 7 beds and 7 bedrooms and 7 bathrooms, but you have 5 self-contained apartments. So they're all right next to each other. And this is a redevelopment opportunity. And that's on sale for 2.3 million. Okay, 55 million rand, which is 1/20th of the R1 billion that you saw from the house just up the road. Okay, but the difference is, with this, you're getting some slippers and a fan, and you're getting an empty bookshelf, and you're getting a not such pretty kitchen, and there's no marble anywhere, and there are no wine bottles, and no fireplace, and a garden that the landscaper hasn't seen. But this is quality. It's in a quality suburb. It's a nice block of a nice apartment block, but it is a completely different price. It's 1/20th of the price. And so when you look at this and you go, okay, well, what have property prices sold for in this area? Well, 37 million, 8.8, 8.5, 8.6, you can see way above 2 million. And so when you look at this and you stand back and you go, what is your potential financial return from buying a perfect house for 43 million pounds? I mean, if something were to happen and you had to pass away and had to get sold to pay your estate, are you going to find somebody who can pay 43 million? If you had a return, you want double that, you're going to find somebody who's going to pay 84 million pounds for one row of chimneys. What's your potential downside? Okay. Whereas, what is your potential financial return if you spend a few $100,000 and you put in a copper bath and you fill it with wine bottles and rip up the timber flooring and put some marble? And what is your potential downside? And that is value investing. How many people would pay 43 million and how many people would pay 2? You can clearly see that your downside is far less with 2 and your upside is far more. And that is all we do. And so, we just look around the world and we look for mispriced assets wherever they are. We don't care about the benchmark. We don't care that, Apple is the biggest holding in NVIDIA. We're not worried that we miss out on those returns because we can find returns elsewhere. And we look across the spectrum, large caps and small caps and, in areas that are out of favor. And we just try and invest like smart business people. And we analyze the long-term cash flow stream and we say, how much has this business made over the last 10 years? And what have they done with it? Have they bought back shares? Were those at decent prices? Have they made acquisitions? Did those acquisitions increase the return on assets? Did they, pay off debt? What has happened and what have they done with that cash flow? And we don't like over-leveraged businesses, and that's particularly important in this day and age with interest rates being where they are. And many companies thought that was going to go on forever and have loaded up their balance sheets, put on hundreds of billions of debt. Well, Oracle's a simple example, actually, to buy back shares. What happened yesterday? Oracle was down 14% in one day. Okay, we want management who are on our side. We want management who, we haven't got time. I'm not plumbers. We're not plumbers. We can't go and put those copper baths in ourselves. We need management who are on our side, who see the value and are doing the sensible things. And if it's mispriced, okay, you get a margin of safety. So when we get it wrong, as Phil rightly said, none of us get it right all the time. The key thing is when we get it wrong, we have to be able to correct those mistakes. And fund managers are very bad at that. No tennis player hits the ball over the net all the time. No surgeon gets it right all the time. No advocate or barrister wins every case. Fund managers are no different. We're going to get it wrong. And when we get it wrong, we don't want to lose too much money. And so we must admit mistakes. And so what I thought I'd do here is just take an example. We don't own Walmart. I'll show the next company we do. And so Walmart probably needs a little in the way of introduction. It is a $440 billion company. It is a giant, and they have $630 billion of revenue, okay? 57% of which is grocery and pharmacy. So what else do they sell? Well, home furniture and appliances and electronics and patio and garden and tires and things like that. But 57%, nearly 400 billion is grocery. Now, if you look, but it's a mega cap. If you look here, what you're looking at here is the blue line is the share price, and the orange line is their forward earnings per share. Okay, so that's the estimated earnings per share that analysts have, and this is just going back 10 years and fiddled with the dates. And you can see that the share price has gone from, and they're both rebased to 100. So the share price has gone from 100 to 230, but the earnings have only gone from 100 to 130. And what is that? That's 2% per annum growth. And that might just amaze you, because you think, well, hang on, this is the biggest retailer. We at a time when everybody wanted to buy stuff and interest rates have been low and the consumer's been spending. How did this company only grow earnings per share 2%? Well, actually, it grew earnings. It didn't grow earnings at all. This is just because of some buybacks that it managed to grow 2%. But what's worrying is the share price increased at 8%, far faster than the earnings level. And why is that? Well, because it's a large cap. And so much of the money in recent years has gone into the mega caps and the large caps because it's been, those are the big companies in the index. And so those have driven the share prices beyond the level of earnings. And so what that means is that 10 years ago, you paid 14 times for Walmart. Today, you're paying 30 times earnings for Walmart. Okay, now, if I mentioned Walmart and I asked the audience, is this a quality company? I'm convinced 90% probably say yes. And it might be. But the point is you're paying 30 times earnings for a company that's not even growing. And what is the fastest part of Walmart's business that is growing? It's grocery. Well, let's have a look at Kroger, because Kroger's a 34 billion. It's not a 440 billion. And this is one of our larger top 10 holdings in the fund. And this has got 148 billion. So it's still a meaningful sized business, of which 90% is grocery and pharmacy. But you can see on the right here, they don't have autos and tires and all those other things. Okay, and so what have they done? Well, their share price has gone from 100 to 300, just over 320, and their earnings has gone from 100 to 320. So guess what? Their earnings have grown at 12% per annum, and the share price has gone up at 12.6, far more in line. And what does that mean? That means that it hasn't re-rated. You're paying 11 times earnings back then, you're paying 11 times earnings now. Okay, so here you've got a business that is exposed to the fastest growing part of Walmart's, of retail, for a third of the price. But it's not a giant, it's a mid-cap stock. And that is where we find opportunities. And that is why we own Kroger and we don't own Walmart. And we look around the world, and what's happened over here in recent years is that you're not allowed to pay your brokerage. You can't buy investment research as part of your brokerage costs, which used to happen. And so that means that fewer people have been buying research from brokers, stockbrokers, and that means that they've had to cut staff. And so they just leave their staff to look at the big companies because that's what everybody's looking at. And that creates opportunities for guys like us who can traffic in smaller and mid-cap companies. And these are not minnows, $43 billion. Now, what Kroger's doing as well is they're buying Albertsons at the moment. They're in a bid to buy Albertsons, which is another big food retailer in the States, and they're working through that at the moment. And there are huge synergies that can take place there. So here we've got management who are doing the stock market equivalent of putting in a copper bath. Okay, we've got management on our side who are doing that, and we're not paying a lot. We've got 11 times earnings. And what are they also exposed to? They're exposed to private label. And in a tough economy, so no name brands, in a tough economy, what does that mean? Well, people no longer want to buy the branded cereals and the branded deodorants and all the rest, they trade down because it's much cheaper and they get better value for money. And so these supermarkets can get exposure to that, and that is one of the areas and one of the reasons why they've managed to grow earnings faster. Okay, and so here's our performance. We've been going since 2008, and this is with a green line. The orange line is the world index. The purple line is the large cap blend equity. We're a value manager, but this is the biggest component, and there's 1,900 funds which have been in existence over the last year in Europe, Africa, and Asia, and we top percentile over the last couple of years, and third percentile since we started. And you can see Morningstar 5-star. Now, what's important, because everybody wants to know, well, what's the outlook and what's going to happen in this region and that region? This has taken place. We've managed to grow our value of the share from our fund from 100 to 427 through many different economic conditions. And if you just think about this period, we've had, that's, the tailwind, the last few months of the global financial crisis. You had the European financial crisis, you had Fukushima, we've had pandemic, record low oil prices, record high oil prices, etc. We still managed to just do what we do, find decent businesses, don't pay too much, admit mistakes when you get them wrong, okay, and just compound through time. And so that is all we do. And in rands, if you translate that into rands, unfortunately with the weakness of the rand, 100 rands gone to 877 rand. If you'd had that in the average fund, it'd be 577 rand. Okay, so as I said, we value investors, and so the weighted average price earnings multiple of the fund is 6.3, world index 17, and you can see big discounts on all these metrics. But we're not going to look like the world. You're not going to be cheaper than the world index if you look like the world index. And so we have more in Japan than we do in North America at the moment. This is the benchmark weighting, is the blue, the green is our fund. Benchmark in North America, 72%. Our fund, 16%. Why? Well, you've heard from other people who've spoken earlier. The US is expensive. And we can't find value in the US. We find a lot more value in Europe, and we find a lot of value in Japan. And we're not afraid to go where there's value. I mean, if we don't think something's cheap, we're not going to buy it. We're not going to have slightly less than the index weighting and be happy with that. And we do have some in emerging markets, and so that is our positioning. I mean, it might surprise you. We have less than 2% in IT. We have no Apple, no Oracle, no Alphabet, no Microsoft. Why? Because we don't think those things offer value. We don't think they offer value, and we're paying a high price. People paying a high price for future earnings. We have our staples. That is where the food retailers that I mentioned a few seconds ago, and we really like European banks. Phil touched on that a second ago. We think they're very well capitalized. They offer very attractive dividend yields. ABN AMRO is on a 10% dividend yield, 5 times earnings, half book value, and exposed to the Dutch economy, which is very resilient, and you don't have crazy property prices. So we don't have US financials, we don't have real estate, we don't have utilities, and that's how our portfolio is currently positioned. The important thing, what I've done here is how does that blend with some of the other funds that you might have? This is the 5 largest feeder funds in South Africa, and this is the correlation matrix, and you can see, and the world index, you can see that we have a 78% correlation with the world index. Many of these other feeder funds, these large global equity feeder funds, have much higher correlations to the world index and to each other. We have very low correlation with many of them. So, hopefully that can help people diversify their risk without sacrificing return, which has been the case historically. And I want to leave you with the point that overpaying for perceived quality can be expensive. This is over the last year, the world index up 12%. Dollar General was perceived as being a high quality, fast growing company, is down 48%. I mean, Estee Lauder, high quality, annuity income, use the creams all the time, down 38%. PayPal down 37%. Just because you are paying for or buying something that you think is quality doesn't mean you're immune from any declines if you pay the wrong price. And so that's it. We've got experienced decision makers in our team, tried and tested process, generated returns, and very high active share, 99% active share, and low correlation with popular funds. Eugene, that's pretty much it.
Sean, thank you very much for that. Very insightful indeed. And it does show that the process works. I mean, the proof's always in the puddings, and it showed in your performance numbers over time. Very quickly, one of the slides that you show us with your regional allocation, when you were out here in May, you did express concerns about the US, and you also mentioned, that you have very strong views on Japan. Looking at your positioning currently relative to the benchmark, which you obviously don't follow, very strong allocations to Japan. Your views on Japan going forward, I mean, is it a macro argument, or is it just where you find some of these really good quality companies at good valuations?
Yeah, Eugene, they are, it is, I guess, mainly, well, I mean, certainly we bottom up investors and we find these great companies that have been ignored because, there's a throwaway comment, oh, Japan, it's got, aging population, bad demographics, don't want to be there. But you've got wonderful companies, and if we can all name I'm sure we can all name 5 Japanese companies that are out there. And what's insightful to me, I mean, you saw that from Phil's slide earlier, is that the topic since the end of September last year is up 27%. And that's importantly, that is in dollars. So it's up even more in yen, but the yen has been weak. And so there are lots of companies. We've got companies in our portfolio, they've got more cash in the balance sheet than the value of the company. And they are buying back shares. And because it's been ignored, it's less liquid. So if a company comes out and says, we're going to buy back 3% of our shares in issue, what you see is the share price respond. Whereas Alphabet announced they're going to buy $70 billion worth of shares in the last set of results. Okay, share price barely moved. So because it's so liquid, and so it's been an ignored market, and that's wonderful opportunities for guys like us. And you think, it should hopefully make people aware that in the US, this year to date, the US obviously has done well only because of those large companies. Japan has done well, almost as well, but not with no exposure to those Magnificent Seven. So there's a real underpin. And what's interesting, I heard the other day, is that if you can speak Japanese, you can get a job at a hedge fund over here, okay? Because they are on the hunt and are looking for people to get exposure to that market. So that just shows you that the money is moving in Japan and it's not over.
My Japanese is horrible. I think I'm going to stay right here. Exactly. Other than Godzilla, but that doesn't count. Sure, just very, very quickly, and it speaks to things like currencies. I mean, you did mention that the yen is undervalued, but I think it's more a case of the dollar being overvalued. And I'm going to pass this question to you because I know you've been in London for decades now, but you're still a South African with roots tying back to Old Mutual decades ago, right? So I still see you as South African. New money's coming, to the market from a SA investor perspective. It's always a bit of a conundrum in terms of how we allocate globally, given where the currency sits at the moment. Just your views quickly. I mean, if we've heard all these things now, a lot of headwinds globally, especially in the US, with fiscal stimulus running out, excess savings running out, so maybe things are a bit more dire there. But we've also seen in the past, if you were to go into a double recession or they do hit a speed bump, how money floods back to the US dollar again. Your views quickly on the US dollar. Is it a currency that's going to stay stronger for longer than one would have hoped for?
Eugene, interesting question, and I don't profess to be a currency strategist, but I will say a couple of things. If you are a South African and you're taking your money offshore and putting it in a fund which has 70% exposed to the dollar, or 80% like some funds, your view on the dollar is quite important. Okay, like with us, you take your 100 Rand and put it offshore, actually only 15 is being exposed to the dollar, because you're also buying yen, which itself is weak. So you're getting so you want to be careful. If you don't want to take a currency call, find a fund that's quite balanced in that regard is the one thing I would say. The second thing is, I think it might be a little bit different this time. I saw an interesting chart the other day, which was the oil price has historically been, when the oil price is up, what you find is that the Middle East take those super profits and put them into US Treasury bills. They're not doing that this time. Okay, so there are fewer people. I mean, if the rates start going up in Japan, you're going to see the Japanese selling their US Treasury bills and bond holdings and repatriate the money back to Japan, which is going to strengthen the yen and weaken the dollar. Well, we know what's happening between China and the US, and now you've got the Middle East also saying, well, hang on, well, not just saying. I mean, the proof is there that they are not investing their super profits in US Treasury bills. So I don't think a bet on a strong dollar is a one-way ticket. I don't think so.
Very thought-provoking in terms of how you balance out in your fund. with currency exposure. Definitely. To our audience out there, the Ranmore funds are available on most of the platforms. And if you want to get more information, we can get hold of Sean. I'm sure we'd like to engage with you as well. Sean, thank you so much for joining us today. It's been really great to have you on with us again. And sorry about the rush to cover a lot of information, but we'll keep contact with you and we'll get you on one of your sessions again in the very, very near future.
Thank you, Eugene. All the best.
Thank you.